Wednesday, March 8, 2023. Silicon Valley Bank's CEO Greg Becker tells clients everything is fine. The bank is strong. Deposits are safe. Do not panic. By Thursday morning, venture capitalists are telling founders to pull their money immediately. By Thursday afternoon, $42 billion have fled the bank, the largest one-day withdrawal in history. By Friday morning, regulators seize Silicon Valley Bank. Greg Becker is out. The bank is dead. 16,000 employees lose their jobs. Shareholders lose everything. The stock, worth $267 on March 7th, is worth zero on March 10th. 48 hours. From the 16th largest bank in America to complete failure. This is the story of Silicon Valley Bank, the CEO who told everyone not to panic just as the panic began, and the fastest collapse in banking history. Let us rewind to 1983. Silicon Valley is emerging as the center of technology innovation. Apple has just launched the Macintosh. Startups are forming in garages. Venture capital is flowing. But traditional banks do not understand this world. They see risk where entrepreneurs see opportunity. A software startup with no revenue, no loan, a hardware company burning cash, no credit line. Founders are frustrated. Two entrepreneurs, Bill Biggerstaff and Robert Medeiros, see the gap. They found Silicon Valley Bank in San Jose, California. The pitch is simple. We understand startups. We know you will lose money for years before you succeed. We know your business model. We will take risks traditional banks will not. SVB's model is brilliant. They offer banking services to venture-backed startups, checking accounts, payroll processing, lines of credit based on venture funding, not revenue. If a startup raises $5 million from Sequoia Capital, SVB will lend them $2 million. The collateral is not assets. It is the venture capital backing. But SVB's real genius is the network effect. Venture capitalists recommend SVB to their portfolio companies. Founders tell other founders. Law firms that specialize in startups refer clients. SVB becomes embedded in the ecosystem. By 1990, they are the bank of choice for tech startups. The relationship is symbiotic. Startups get banking services tailored to their needs. SVB gets deposits. Lots of deposits. When a startup raises $10 million, that money sits in an SVB account, sometimes for years, as the company slowly burns through it. SVB takes those deposits and invests them, earning returns. It is a beautiful model. As long as venture capital keeps flowing and startups keep raising money, SVB keeps growing. By 2000, during the dot-com boom, SVB is thriving. They have expanded beyond Silicon Valley to Boston, Austin, and other tech hubs. They have billions in deposits. They go public. The stock soars. SVB is no longer just a bank. They are an institution, a badge of credibility. If SVB banks you, you are legit. The 2000s and 2010s are extraordinary for Silicon Valley Bank. Every major tech trend benefits them. The rise of social media, Facebook, Twitter, LinkedIn. The mobile revolution, iPhone apps, Android. Cloud computing, Amazon Web Services, Salesforce. Sharing economy, Uber, Airbnb. Each wave brings thousands of new startups, and most of them bank with SVB. By 2015, SVB has over $120 billion in deposits. They are the 16th largest bank in America, but they are number one in the tech industry. Half of all venture-backed startups in the United States bank with SVB. Their client list reads like a who's who of innovation. Shopify, Roku, Pinterest, Fitbit, Ring, Roblox. SVB's culture is unique. They do not operate like traditional banks. Their bankers attend startup conferences. They host networking events. They publish research reports on tech trends. They are part of the community, not outside observers. This builds loyalty. Founders trust SVB because SVB understands them. But there is a hidden risk in SVB's model. Their deposits are not diversified. Most come from startups, and most startups bank only with SVB. Traditional banks have millions of small depositors. If one withdraws money, it does not matter. But SVB has 40,000 large depositors. If they coordinate and withdraw simultaneously, it is catastrophic. There is another risk: FDIC insurance. The Federal Deposit Insurance Corporation insures deposits up to $250,000. For normal people, that is plenty. But startups have millions in their accounts. Payroll for 100 employees. Burn rate for 6 months. Only a fraction is insured. If SVB fails, startups lose everything above $250,000. But nobody worries about this. SVB is strong. SVB is safe. SVB is too important to fail. To understand SVB's collapse, we need to understand interest rates. From 2008 to 2021, the Federal Reserve kept interest rates near zero. This was a response to the financial crisis and then the pandemic. Low rates encouraged borrowing and investment. It was great for startups. Venture capital was cheap. Valuations soared. Fundraising was easy, but low rates created problems. Inflation started rising. By 2021, prices were increasing at the fastest pace in 40 years. The Federal Reserve faced a choice: let inflation run wild or raise interest rates to cool the economy. In March 2022, the Fed started raising rates, slowly at first, then aggressively. By March 2023, rates had gone from 0% to nearly 5% in just 1 year. The fastest rate increase in decades. Rising interest rates have two effects. First, they make borrowing expensive. Startups that could raise money easily in 2021 now struggle. Venture capitalists become cautious. Fundraising slows. Startups burn through their cash reserves. Second, rising rates destroy bond values. Here is why. Imagine you buy a bond that pays 2% interest, then interest rates rise to 5%. New bonds now pay 5%. Your 2% bond is worth less because nobody wants it when they can get 5% elsewhere. The longer the bond's maturity, the bigger the loss. A 30-year bond loses far more value than a 1-year bond. This is where Silicon Valley Bank made its fatal mistake. Silicon Valley Bank had a problem. They had over $100 billion in deposits from startups. That money was just sitting there. Banks do not keep deposits in cash. They invest them to earn returns. SVB needed to invest wisely. From 2020 to 2021, SVB made a massive bet. They bought over $80 billion in long-term bonds, mortgage-backed securities, treasury bonds, most with maturities of 10 years or longer. The bonds paid 2% to 3% interest. Not great, but safe. Or so they thought. Why did SVB buy long-term bonds? Because short-term bonds paid almost nothing. Interest rates were near zero. SVB wanted higher yields. Long-term bonds paid more. SVB's leadership believed rates would stay low forever. The Fed had kept rates near zero for over a decade. Why would that change? They were wrong. When the Fed started raising rates in 2022, SVB's bond portfolio collapsed in value. A bond paying 2% is worthless when new bonds pay 5%. On paper, SVB's bonds lost over $15 billion in value. $15 billion, gone. But SVB did not have to realize those losses immediately. Accounting rules allowed them to hold the bonds to maturity and avoid marking them to market. As long as they did not sell the bonds, the losses stayed hidden. This is called held-to-maturity accounting. It was legal, but it was dangerous. Here is why. SVB's business model depended on deposits staying stable. As long as startups kept their money in SVB accounts, everything was fine. SVB could hold the bonds to maturity, collect the interest, and never realize the losses. But if startups started withdrawing money, SVB would have to sell bonds at massive losses to cover the withdrawals. And once startups started pulling money, others would panic and pull theirs too. A bank run. By late 2022, cracks were appearing. Startups were struggling. Fundraising had dried up. Layoffs were spreading across the tech industry. Companies were burning through cash reserves. They needed to access their SVB deposits. SVB's deposit base started shrinking from $198 billion in March 2022 to $173 billion in December. $25 billion withdrawn in 9 months. SVB had to sell bonds to cover withdrawals. Those sales meant realizing losses. By the end of 2022, SVB had sold $12 billion in bonds, locking in losses of nearly $2 billion. But management stayed optimistic. CEO Greg Becker, who had been with SVB since 1993 and CEO since 2011, believed the worst was over. In earnings calls, he reassured investors, "We are managing the situation. Our balance sheet is strong. Deposits will stabilize." The stock price hovered around $250. Behind the scenes, alarm bells were ringing. SVB's held-to-maturity bond portfolio was underwater by $15 billion. If they had to sell those bonds, they would be insolvent. The bank's equity was only $16 billion. A full liquidation of the bond portfolio would wipe out all equity. In January 2023, rating agencies started asking questions. Moody's and S&P wanted to understand SVB's exposure to rising rates. SVB's answers were not reassuring. The agencies put SVB on watch for potential downgrade. By early March, SVB's leadership knew they had a problem. Deposits were still falling. Startups were withdrawing money to cover operating expenses. SVB needed more capital. On March 8, 2023, they made an announcement that would trigger the collapse. Wednesday, March 8, 2023. Silicon Valley Bank announces a plan to raise $2.25 billion in new capital. They are selling shares. Why? Because they need to shore up their balance sheet. They also announced they have sold $21 billion in bonds, realizing a $1.8 billion loss. The market reacts instantly. The stock drops 26% in pre-market trading. By the close, it is down 60%. Investors are terrified. If SVB needs to raise capital urgently, the situation must be dire. Shareholders are being diluted. And the bond losses confirm what analysts suspected. SVB is in trouble. But the real panic starts in the startup community. Founders and CFOs read the announcement. They see the bond losses. They see the capital raise. They start asking questions. Is our money safe? Should we move it? They message each other. They post in Slack channels. They discuss in group chats. Then the venture capitalists weigh in. Peter Thiel's Founders Fund reportedly advises portfolio companies to withdraw funds from SVB. Other VCs do the same. By Wednesday evening, the message is spreading. Get your money out of SVB. At 3:30 p.m. Pacific, Jason Calacanis, a prominent venture capitalist, tweets, "If you have more than the FDIC-limited SVB, you should get your money out now." The tweet goes viral. Founders see it. They panic. Within hours, they are initiating wire transfers out of SVB. By Wednesday night, SVB's management realizes they have a crisis. Withdrawals are accelerating. They hold emergency meetings. They call regulators. They prepare talking points. But it is too late. The bank run has begun. Thursday, March 9th. The bank run becomes a stampede. Startups are frantically moving money. Wire transfers. ACK transfers. Anything to get funds out of SVB. By midday, $42 billion have been withdrawn. $42 billion in one day. It is the largest single-day bank run in American history. For context, during the 2008 financial crisis, Washington Mutual had $16.7 billion withdrawn over 10 days. SVB loses $42 billion in 24 hours. Why so fast? Digital banking. In the old days, bank runs required people to physically line up at branches. It took time. News spread slowly. But in 2023, you can withdraw millions with a few clicks. Founders do not need to visit a branch. They log into their accounts, initiate transfers, and the money moves instantly. Social media amplifies the panic. A tweet reaches thousands in seconds. Group chats coordinate withdrawals. The bank run is digital, instant, and unstoppable. SVB tries to stop the bleeding. Greg Becker sends a letter to clients. Do not panic. We are strong. Your deposits are safe. But nobody believes him. Founders trust their VC backers more than the CEO, and VCs are saying, get out now. By Thursday afternoon, SVB is insolvent. They do not have enough cash to cover withdrawals. They go to the Federal Reserve for emergency funding. The Fed lends them, but it is not enough. SVB needs to sell more bonds, realizing more losses. The death spiral accelerates. Trading in SVB's stock is halted multiple times as it plunges. By the close, the stock is down another 60%. It is now worth $60, down from $267 on Tuesday. Shareholders have lost billions. That evening, regulators step in. The California Department of Financial Protection and Innovation takes control of Silicon Valley Bank. The Federal Deposit Insurance Corporation is appointed receiver. Silicon Valley Bank is closed. Greg Becker is removed as CEO. The bank is dead. 48 hours after the announcement, Silicon Valley Bank is gone. Friday, March 10th, 2023. Startups wake up to nightmare headlines. Silicon Valley Bank has been seized. Deposits above $250,000 are frozen. Nobody knows when or if they will get their money back. For thousands of startups, this is catastrophic. They cannot make payroll. Employees are supposed to be paid Friday. The money is gone. They cannot pay rent. They cannot pay suppliers. They cannot buy equipment. Cash flow is stopped. Companies face immediate shutdown. Founders are in crisis mode. Emergency board meetings. Panicked calls with investors. Desperate searches for alternative funding. Some companies have multiple bank accounts and can survive. But many banked exclusively with SVB. They are out of options. The human cost is immediate. Roku, a streaming device company, discloses they have $487 million at SVB, 26% of their cash. Roblox, a gaming company, has $150 million at SVB. Smaller startups have their entire runway frozen. CEOs are trying to figure out how to tell employees they might not get paid. The panic spreads beyond SVB. Customers at other regional banks start pulling money. First Republic Bank, another California institution, sees massive withdrawals. Signature Bank in New York faces a similar run. By Sunday, Signature Bank is also seized by regulators. 2 major banks have failed in 48 hours. The fear is contagion. Could this be 2008 all over again? Venture capitalists are furious. Many blame SVB's management. How could they be so reckless? How could they bet everything on low rates? Some blame regulators for not intervening sooner. Others blame the Fed for raising rates too quickly. The blame game is fierce. Saturday and Sunday, March 11th and 12th. Treasury Secretary Janet Yellen, Federal Reserve Chair Jerome Powell, and FDIC Chair Martin Gruenberg face a choice. Let SVB depositors take losses or guarantee all deposits, even above the FDIC limit. Normally, FDIC insurance covers only $250,000. Anything above that is at risk. This encourages depositors to choose stable banks. It is called market discipline. But SVB's depositors are not rich individuals hiding wealth. They are startups. Small businesses. If they lose their deposits, thousands of companies shut down. Hundreds of thousands of jobs disappear. The tech ecosystem collapses. Yellen, Powell, and Gruenberg decide. Guarantee all deposits. The FDIC will make depositors whole even above the limit. How? By using the FDIC's deposit insurance fund, paid for by fees on all banks, not taxpayer money. This is not a bailout of SVB. The bank is dead. Shareholders lose everything. Bondholders take losses. Management is fired, but depositors are protected. Sunday evening, March 12th, the announcement is made. All Silicon Valley Bank depositors will have access to their funds by Monday morning. Every dollar is safe. The tech community breathes a sigh of relief. Payrolls will be met. Companies will survive. The immediate crisis is averted, but the decision is controversial. Critics argue this is a backdoor bailout. If all deposits are guaranteed, what is the point of the $250,000 limit? Moral hazard returns. Banks can take risks, knowing the government will protect their depositors. Supporters argue this was an emergency. Letting thousands of startups fail would have destroyed the economy. The debate continues. But for now, the crisis is contained. Startups get their money back. The tech industry survives. Silicon Valley Bank does not. In the aftermath, investigators, regulators, and analysts dissect what happened. How did Silicon Valley Bank fail so spectacularly? The answers are clear. First, concentration risk. SVB had a narrow deposit base, 40,000 clients, mostly startups, mostly in tech. When the tech industry struggled, SVB's deposits evaporated. A diversified bank would have survived. SVB did not. Second, interest rate risk. SVB bet that rates would stay low. They bought $80 billion in long-term bonds. When rates rose, those bonds lost value. SVB should have hedged. They should have bought interest rate swaps or shorter-term bonds. They did not. Third, liquidity risk. SVB did not have enough cash to cover a bank run. They assumed deposits were stable. They were not. When $42 billion fled in one day, SVB could not respond. Fourth, regulatory failure. SVB was subject to lighter regulations than the largest banks. After the Dodd-Frank reforms of 2010, banks with over $50 billion in assets faced strict stress tests and capital requirements. But in 2018, Congress raised the threshold to $250 billion. SVB, with $173 billion, fell below the line. They avoided strict oversight. Regulators failed to see the risks. Fifth, social media and digital banking. The bank run was faster than any in history because of technology. Founders coordinated on Twitter, Slack, and WhatsApp. Withdrawals happened with clicks, not visits to branches. The speed was unprecedented. Regulators were not prepared. Finally, management failure. Greg Becker and SVB's leadership made catastrophic decisions. They ignored warnings. They failed to hedge risks. They reassured clients even as the bank was collapsing. Leadership failed. Greg Becker joined Silicon Valley Bank in 1993, just 10 years after its founding. He was a relationship manager, working with startups and VCs. He rose through the ranks, becoming CEO in 2011. Under his leadership, SVB grew from $30 billion in assets to over $200 billion. He was celebrated as a visionary, someone who understood the startup ecosystem. But Becker made fatal mistakes. In 2020 and 2021, as deposits surged during the tech boom, he invested heavily in long-term bonds. He believed rates would stay low. He did not hedge. When rates rose, he doubled down, insisting the situation was temporary. In congressional hearings after the collapse, Becker was grilled. Lawmakers asked, "Why did you not hedge interest rate risk? Why did you concentrate so much in long-term bonds? Why did you tell clients everything was fine on March 8th when the bank was collapsing?" Becker defended his decisions. He blamed the Fed for raising rates too quickly. He blamed social media for spreading panic. He accepted no personal responsibility. Becker lost everything. His SVB stock, worth over $100 million in early 2023, became worthless. He was fired. His reputation was destroyed. He is now a cautionary tale, the CEO who grew a bank to dizzying heights and then crashed it in 48 hours. Silicon Valley. Banks' collapse sent shockwaves beyond startups. Other regional banks faced runs. First Republic Bank, based in San Francisco, saw depositors flee. Their stock plunged. Within weeks, J.P. Morgan Chase acquired First Republic in a government-facilitated deal. Signature Bank in New York also collapsed, seized by regulators the same weekend as SVB. In Europe, Credit Suisse, a 167-year-old Swiss bank, faced a crisis. Already weakened by scandals and losses, Credit Suisse saw depositors panic after SVB's collapse. Within days, Swiss regulators forced a merger with UBS. Credit Suisse disappeared. The fear was systemic contagion. Would depositors lose confidence in all banks? Would more runs occur? The Federal Reserve acted quickly. They created a new lending facility, allowing banks to borrow against their bond portfolios at face value, not market value. This prevented forced sales of underwater bonds. The crisis stabilized, but the damage was done. Regional banks were under scrutiny. Regulations were questioned. The startup ecosystem was shaken. Venture capital slowed further. Startups became even more cautious. The ripple effects lasted months. For the startup world, SVB's collapse was a wake-up call. For decades, founders had trusted SVB implicitly. SVB understood them. SVB supported them. SVB was safe. That trust was shattered. Founders learned harsh lessons. First, diversify your banking. Do not keep all your money in one bank. Spread it across multiple institutions. Even if it is inconvenient, it is safer. Second, understand FDIC limits. Most founders did not realize their deposits were uninsured above $250,000. Now they know. Many startups now use services that spread deposits across multiple banks to maximize FDIC coverage. Third, monitor your bank's financial health. Founders assumed SVB was safe because everyone used them. They did not check SVB's balance sheet. They did not understand interest rate risk. Ignorance was not bliss. It was dangerous. Fourth, social media can trigger bank runs. The speed of SVB's collapse was unprecedented. Tweets and group chats coordinated withdrawals. Founders now understand that panic spreads instantly in the digital age. Fifth, government intervention is unpredictable. Depositors were saved, but only because regulators decided to act. There was no guarantee. Founders cannot assume the government will always step in. The startup ecosystem survived, but it changed. Trust in banks is lower. Caution is higher. The era of easy money and careless banking is over. After SVB's collapse, regulators promised reforms. The Federal Reserve launched an investigation. In April 2023, they released a report blaming SVB's management and admitting regulatory failures. The Fed acknowledged they should have intervened sooner. Proposals emerged. Reinstate strict regulations for banks over $100 billion in assets. Require stress tests for interest rate risk. Force banks to hold more liquid assets. Increase scrutiny of regional banks. Some of these proposals became law. Others stalled in Congress. The debate over FDIC insurance intensified. Should the limit be raised from $250,000 to $1 million? Should it be unlimited? Supporters argue higher limits would prevent future runs. Critics argue unlimited insurance creates moral hazard. Banks would take excessive risks knowing depositors are fully protected. The debate over too big to fail also returned. Silicon Valley Bank was not systemically important like JP Morgan or Bank of America, yet regulators felt compelled to save depositors. Does this mean all banks are too big to fail? If so, why have limits at all? These questions remain unresolved. The regulatory system is patched, not fixed. Another crisis is inevitable. The question is when? Silicon Valley Bank's legacy is complex. For 40 years, they were a pillar of the startup ecosystem. They funded innovation. They supported dreamers. They took risks traditional banks would not. Apple, Google, Facebook, thousands of startups owe their success in part to SVB's willingness to bank them when nobody else would. But SVB also failed catastrophically. They grew too fast. They concentrated too much risk. They made a massive, unhedged bet on interest rates. They ignored warnings. They reassured clients as the bank burned. In 48 hours, they went from hero to zero. The lessons are clear. Banks must manage risk carefully. Concentration is dangerous. Hedging is essential. Transparency builds trust. Overconfidence kills. These are not new lessons. They are ancient lessons. Yet every generation forgets them and learns them again the hard way. For the startup world, SVB's collapse is a reminder that nothing is permanent. Institutions that seem invincible can fall overnight. Trust must be earned daily, not assumed. Diversification is survival. For regulators, SVB is evidence that the financial system is fragile. Digital banking accelerates crises. Social media spreads panic. Intervention must be swift, but intervention creates moral hazard. The balance is delicate. For the broader public, SVB is another example of financial system dysfunction. Banks take risks. When bets pay off, executives get rich. When bets fail, taxpayers or depositors or employees pay the price. The system privatizes gains and socializes losses. This is not new, but it is enduring. Today, Silicon Valley Bank is a memory. The name still exists, owned by First Citizens Bank, which bought the remnants. But the institution, the culture, the trust are gone. Founders who banked with SVB for decades now spread their deposits across Chase, Wells Fargo, and fintech startups offering multi-bank FDIC coverage. Greg Becker is retired, his reputation destroyed. The 16,000 SVB employees scattered to other banks and companies. Shareholders lost everything. The stock that traded at $267 is worthless, but the startup ecosystem survived. Payrolls were met. Companies continued operating. Venture capital, though slower, still flows. Innovation continues. Silicon Valley, the place and the industry, proved resilient. The lessons from SVB's collapse are already fading. Memories are short. New crises will come. New banks will make new mistakes. The cycle continues. The story of Silicon Valley Bank is not just about one bank. It is about trust, risk, panic, and the fragility of the financial system. It is about how 40 years of success can be destroyed in 48 hours. It is about how digital technology accelerates everything, including collapse. It is about how humans repeat mistakes, generation after generation, believing this time is different. Silicon Valley Bank was too important to fail. Until it did. The fastest bank collapse in American history. From hero to zero in 48 hours.